Hassan, thanks so much for joining us.
You're welcome.
Now, the Westpac Consumer Survey was released this week, Consumer Sentiment Survey, showing sentiment returning almost to pre-COVID-19 levels.
Yeah, pretty spectacular rebound in confidence. I remember back in April when the lockdown got put in place, sentiment plunged 20%. It was the worst decline we'd seen in over 40 years in the records that we've been running the survey. And lo and behold, 2 months later, we are nearly all the way back to pre-virus levels. We're just about 2% below the average sentiment read over the 6 months to February. So not quite there, but 2% is a lot better than being down 20-odd%.
Despite that, though, Matt, actual consumer confidence still remains low and conditions are low. We're in a recession now. Where do you see the next data going?
Yeah, look, we still think this is going to be a slow road to recovery. Obviously, the coronavirus restrictions being lifted are allowing us to see a bit of a pop, and confidence in part is up because those restrictions are gone, and so now it's viewed as a much better time to go shopping, for example. But when we ask around questions about the economic outlook, it's still pretty downbeat. Consumers, in terms of their assessments of their own finances over the last 12 months, are still pretty downbeat. Actually, they point to quite significant pressures on family finances at this stage. The expectations side of things is more positive. So on that front, beyond the near-term economic difficulties, they are expecting to see their family finances improve over the next 12 months, and the view around the economy is very positive over the next 5 years. But I think that suggests that we are still a little bit fragile. Sentiment's still below 100. It's still pessimistic on balance. And there's some fragility there if some of these expectations are not met. If there's more issues around the legacies, the longer-lasting legacies of the recession, around the labour market in particular, then confidence could fade out a little bit from here. And I think we're going to have I think it's still going to be slow going for the economic recovery, including for the consumer.
Well, speaking of employment, Treasury's revised estimates on the economic impact of COVID-19, saying unemployment now to reach only 8%, obviously very high by Australian standards, but lower than the 10% predicted earlier.
That's right. There's no doubt about it. We are seeing big steps in the right direction, significant steps in the right direction, that the outlook for the economy has improved given how well we've done in containing the virus. The labour market situation doesn't look quite as bad, and we moved in a similar way to lower our unemployment rate forecast a couple of weeks ago. So we see a similar path. The 8% unemployment rate, much better sounding than 10 to 13%, certainly a lot better than 18 to 20%. But compared to where we're coming from, around about 5%, that's still a material shock. That's a recession. And there'll be a legacy from that shock to households and household incomes that'll be slower to play through the economy at the moment. In a way, we're kind of in a bit of a coma at the moment. We've got put into a fiscal coma during the lockdown where we weren't allowed to spend, and we were being propped up in terms of incomes through JobKeeper and JobSeeker measures, and also holidays around home loan repayments. But as we come out of that coma, it's going to be clear that there was a material hit to our incomes, and that's going to be a headwind to growth. It's going to look good compared to what we've been contemplating a couple of months ago, but still slow going.
On housing, Matt, the ABS figures came out this week. They've fallen sharply for April. Number of loans to owner-occupiers falling by about 6.3%. Your thoughts on that and the broader housing market situation?
So with housing, there's more weakness to come through. Some of this data's really lagged. So in the case of housing finance approvals, the figures are for April, but they reflect applications that mostly were put in ahead of the coronavirus in March. So there's going to be more negative news around finance approvals. A 5% drop is actually kind of small compared to the 15 to 20% drop we've seen in retail sales and in housing market turnover was down about 40%. So those sort of indicators, they're still catching up to developments during the lockdown period. Aside from that, I think the key with housing is that it's not so much the direct effects of the lockdown. It's not that we were banned from holding auctions and going to open homes. Those disruptions aren't really the main game for housing. The main game for housing is how the wider economic impact, particularly to the labour market and to household incomes, filters through to the market over the course of the rest of the year. And I think with housing, we're not going to get a really good, true read on how that's playing out until we get well into the third quarter. Look, we're here sort of in mid-June. It's going to be about August, September when we get a true read on housing. That's going to be the period where we're also starting to see some of the supports to the household sector withdrawn. So the fiscal policies around JobKeeper and JobSeeker payments, but also some of these home loan repayment holidays will be rolling off.
Matt Hassan, thanks so much for your time.